Silver just crashed 47% in 7 trading sessions, from $121 to $65, the fastest collapse in 45 years. And while you were watching your portfolio bleed, while retail traders were getting liquidated by the millions, while the mainstream media told you the bull market was over, something strange was happening behind the scenes. The same banks that crashed the price were quietly accumulating physical silver at the exact bottom. JP Morgan took delivery of 8.1 million ounces on a single day. That was 99% of all deliveries that day. Everyone else combined got 1%. Let me say that again so it sinks in. The price crashes 47%. Retail traders get wiped out, and the biggest bank in America is backing up trucks to load physical silver. Does that sound like a coincidence to you? Does that sound like a free market? By the end of this video, you will understand exactly what happened, who engineered this crash, and why silver is not going to $50. It is going to $500, and I am going to show you the data that proves it. Welcome to the hidden economy. If you are new here, I expose what is really happening in markets while everyone else is distracted by the headlines. I do not do hype. I do not do hopium. I show you verified data from real institutions so you can make informed decisions. Subscribe right now because this is the kind of analysis you will not find anywhere else. And if you find value in this video, smash that like button. It helps the algorithm show this to more people who need to see it. Now let me show you what really happened last week, because the story the media is telling you is not the real story. They want you to believe this was a normal correction. They want you to believe silver got ahead of itself. They want you to believe retail traders caused this crash by being too greedy. That is a lie. This crash was manufactured. It was engineered with surgical precision, and I can prove it with one simple fact. The CME, which is the exchange where silver futures trade, raised margin requirements 8 times in 8 weeks. 8 times. Let me put that in perspective for you. In 2024, the entire year, there were 2 margin hikes. In 2023, there were 3. In 2022, there were 2. 7 margin hikes in 3 years was normal. 8 margin hikes in 8 weeks has never happened before in the history of the exchange. I went through 20 years of data. This is unprecedented. Now let me explain what a margin hike does, because most people do not understand this. And that misunderstanding is costing them money. When you trade futures, you put down a deposit. Think of it like a down payment on a house. If you want to control $100,000 worth of silver, you might put down $10,000. That $10,000 is your margin, your skin in the game. Now here is where it gets dangerous. If the exchange decides to raise margin requirements overnight, you suddenly need more cash. Not next week, not when your bank transfer clears. Immediately, right now. And if you do not have the cash sitting ready, your position gets liquidated. The exchange sells you out automatically at whatever price exists at that moment. And when everyone is getting liquidated at the same moment, the price at that moment is terrible. Rock bottom. The worst possible exit. Think of it like a game of musical chairs. When the music stops, everyone scrambles for a seat. But what if someone keeps removing chairs while the music is still playing? That is what 8 margin hikes does. It removes chairs one by one until there are not enough seats for everyone. Then they stop the music and watch retail traders get crushed. 1 margin hike is survivable. Most traders keep some buffer. But 8 margin hikes in 8 weeks, that is not survivable. That is extermination. That is what happened last week. Christmas Day, margin hike. New Year weekend, margin hike. Every time traders caught their breath, another hike. Then came the kill shot. January 13th, the CME switched to percentage-based margins. Now when silver rises, your margin requirement rises automatically. A trap that tightens itself. The higher silver goes, the more cash you need, even if you do nothing. And they did not stop after the 47% crash. The day after the worst single day in 45 years, they raised margins again. Think about that. The market just crashed 38% in one day. Traders are bleeding out. Accounts are being wiped. And the exchange raises margins again the very next morning. That is not risk management. That is a coordinated attack. Now let me show you who benefits from this attack, because understanding the players is critical. JP Morgan holds the largest silver short position of any bank in history. They have been short silver for over a decade. Every single dollar that silver drops, they make hundreds of millions. In 2020, they paid $920 million in fines for manipulating the silver market, the largest fine ever paid by a bank for precious metals manipulation. They got caught. They paid the fine. And you know what happened next? Nothing. They kept their silver. They kept buying more. And they kept shorting. $920 million sounds like a lot until you realize that is pocket change compared to what they make from manipulation. It is the cost of doing business. A speeding ticket on the way to robbing the bank. Bank of America, massive shorts. HSBC, massive shorts. These banks sit on CME committees. They have visibility into positioning. They know exactly where the pressure points are. They know where your stop losses are. They know how much margin you have. And they use that information to crush you. This is not conspiracy theory. This is documented. The $920 million fine proves it. The 8 margin hikes prove it. The timing proves it. Speaking of timing, let me tell you about something that happened Thursday night, just hours before the Friday crash. Reuters published a story claiming the US government was ending support for strategic metals. Anonymous sources. No verification. Algorithms read the headline and triggered selling. The cascade began. 3 hours later, the Energy Department issued a statement. Quote, "The article is false and relies on sources that are misinformed or deliberately misleading." End quote. False. Completely made up. But by then the damage was done. Markets had already crashed. Algorithms do not reverse for corrections. And here is what kept me awake that night. The day before the crash, Thursday, there was unusual options activity on silver ETFs. Massive put buying. Someone made huge bets that silver would collapse the day before it happened. Either someone got very lucky or someone knew what was coming. Draw your own conclusions. Now let me show you the smoking gun. The evidence that tells you this is not a real crash. This is manufactured. Pull up two prices right now while you are watching this video. COMEX silver. That is the paper price. The price you see on CNBC. And Shanghai silver, that is the physical price, where actual metal changes hands. COMEX paper price around $78 right now after the bounce. Shanghai physical price over $100. Same metal, same day, same planet, more than $20 difference. Let me ask you a simple question. If silver was really worth $78, why would sophisticated Chinese buyers pay over $100? Why would manufacturers who need this metal for production pay 30% more than they have to? They would not, unless they know something. They know the paper price is fake. They know $78 is a manipulated number. They know the real value of silver is closer to what they are paying, and the gap is not closing. It is widening. When COMEX crashes, Shanghai does not crash with it. Physical is holding while paper collapses. That tells you everything. One of these prices is a lie, and it is not the Shanghai price. Now let me show you why this manipulation cannot last and why silver is going to $500. And I want you to pay very close attention to these numbers because they are going to change how you see this entire market. COMEX registered silver inventory right now is 103 million ounces. That is all the silver available for delivery. March open interest, meaning contracts that could demand delivery, is 429 million ounces. Read those numbers again. 103 million available, 429 million promised. They have promised 4 times more silver than physically exists in the entire COMEX warehouse system. Now here is where it gets critical. First notice day for March contracts is February 27th. That is 3 weeks away. On that day, every trader holding a March contract must declare their intention: cash settlement or physical delivery. In January, deliveries were 49.4 million ounces. That is 7.27 times the level of January 2024. 7 times more people are demanding physical metal than last year. In February, the delivery rate has been 98%. Almost everyone who held contracts demanded the actual metal. If March sees even 25% of contracts stand for delivery, COMEX would need 107 million ounces. More than they have. If March sees 50% to 70% delivery rate like January and February, they would need 200 to 300 million ounces against 103 million available. The math does not work. There is not enough silver. And every single day, the vault is draining. The drainage rate right now is 785,000 ounces per day. At that rate, by first notice day, they could have less than 85 million ounces against 429 million in promised delivery. This is not speculation, this is not theory, this is math, simple math that anyone can verify. Now let me show you what is happening in China because this is where you see the real demand. Shanghai Futures Exchange and Shanghai Gold Exchange combined hold approximately 850 tons of silver. Since 2020, approximately 6,600 tons have been drained. That is a 90% draw in 6 years. 90%. And it is accelerating. Just this week, 73 tons were pulled from Chinese vaults in a single day. 73 tons in one day. At this rate, Chinese vaults will be completely empty in 11 days. Let me say that again, 11 days. If the current drainage rate continues, there will be no silver left in Chinese vaults in less than 2 weeks. And you know what Chinese buyers are doing while the paper price crashes? They are stacking. They are buying physical silver with both hands. They are taking delivery. They are loading trucks and moving metal into private storage. While Western retail traders panic sell at the bottom, Chinese institutions are accumulating everything they can find. They know what silver is really worth. They know $78 is a gift. They know what is coming. Now let me explain why silver is going to $500 and why this number is not hype. It is based on fundamentals that have not changed despite the crash. Silver has been in supply deficit for 5 consecutive years. Every year since 2021, the world has consumed more silver than it produced. The cumulative deficit is now over 800 million ounces. That is 800 million ounces of demand that exceeded supply. Where did that silver come from? It came from stockpiles, from vaults, from reserves that were built up over decades. Those stockpiles are now running dangerously low. The The buffer is almost gone. There is no emergency reserve to tap into when demand spikes. Global mine production is about 835 million ounces per year. That is total supply, but demand is over 1 billion ounces. Industrial demand for solar panels, every single panel needs silver. Electronics, your phone has silver in it. Electric vehicles, every EV uses more silver than a regular car. AI chips, data centers, servers, all need silver. And here's the part nobody is talking about. 70 to 80% of silver comes as a byproduct of mining other metals: copper, zinc, lead. Only 20% comes from actual silver mines. So even if silver hits $500, miners cannot just produce more. They have to mine more copper first. That takes years. New mines take 7 to 10 years to develop. Supply cannot respond fast enough. Now let me give you historical perspective, because history tells us exactly what happens when these conditions align. In 1979 and 1980, the Hunt brothers accumulated about 200 million ounces of silver. They drove the price from $6 to $50, an 8 times increase. JP Morgan today holds 750 million ounces, 3.75 times more than the Hunt brothers at their peak. If 200 million ounces could move silver from 6 to 50, what can 750 million do? But here is the difference. The Hunt brothers used leverage. They bought on margin. When the government changed the rules, they could not pay their margin calls. They went bankrupt. JP Morgan bought physical silver, actual metal, no leverage, no debt, no margin. You cannot margin call someone who owns the real thing outright. They learned from the Hunt brothers' mistake. They accumulated slowly for 15 years while keeping prices low with paper shorts. And in October 2025, they did something unprecedented. They closed their entire short position. 200 million ounces of bets against silver gone. For the first time in their history, JP Morgan is now completely long silver. Think about what that means. For 15 years, they benefited from silver prices staying low. That helped them accumulate cheaply. Now they want prices to go up. The accumulation phase is over. The profit phase has begun. And here's the math. JP Morgan holds 750 million ounces. Every single dollar silver goes up, they make $750 million. Not per year. Not per month. Per dollar. If silver goes from 100 to 200, they make $75 billion. If silver goes to 300, they make $150 billion. If silver goes to 500, they make $300 billion. Do you think they accumulated 750 million ounces to watch silver stay at 100? They did this to make hundreds of billions. And when they make hundreds of billions, where does that money come from? It comes from everyone who did not position themselves. It comes from everyone who panicked and sold at the bottom. It comes from every retail trader who got liquidated by 8 margin hikes. Now let me address what just happened in the last 24 hours, because this is important. Silver bounced 22% from $65 to $78. Bitcoin added $11,000, reclaiming $70,000. Crypto added $340 billion in market cap. The Dow hit a new all-time high. Risk assets across the board are recovering violently. But here is what is more important than the bounce. Silver lease rates just jumped to 6.1% in London. Normal lease rates are 0.3 to 0.5%. 6.1% is 12 to 20 times higher than normal. This is what it costs to borrow physical silver. When lease rates spike like this, it means physical silver is so scarce that holders are demanding massive premiums just to temporarily lend it out. This tells you everything about the crash. This was leverage and paper getting flushed, not a collapse in physical demand. If supply were loose, professionals would not be paying top dollar to borrow silver right now. Silver is also in backwardation. This is when the spot price is higher than futures prices. In normal markets, futures trade higher than spot because of storage and interest costs. When spot trades higher than futures, it means buyers want the metal now. They do not want to wait. They are willing to pay more for immediate delivery. Backwardation signals extreme physical tightness. It signals that the market does not believe future delivery promises. People want metal in hand, not paper promises. Now let me tell you about the opportunity that this crash created, because this is where it gets personal for you. Last week, millions of retail traders were liquidated. Accounts wiped, positions forced closed at the worst possible prices. These traders were right about silver. They understood the fundamentals. They saw the supply deficit. They knew about industrial demand. They were positioned correctly, and they still got destroyed. Not because they were wrong, because they were leveraged, because they did not have enough margin buffer, because 8 coordinated margin hikes shook them out at the exact bottom. Their silver went somewhere. When a position gets liquidated, someone else is on the other side of that trade. Someone bought their silver at $65. Who do you think was buying? The same institutions that engineered the crash, the same banks that raised margins 8 times, the same players who knew exactly when to attack. This is how wealth gets transferred. From the emotional to the rational, from the leverage to the patient, from retail traders who react to institutional players who prepare. Last week was the largest wealth transfer in the silver market since 2011. If you sold at the bottom, your silver went to JP Morgan, to sovereign wealth funds, to Chinese institutions. They thank you for the discount. But here is the opportunity. The fundamentals have not changed. The supply deficit is still real. Industrial demand is still growing. China is still draining vaults. March delivery crisis is still coming. The only thing that changed is the price. And the price changed because paper was manipulated, not because physical reality changed. If you understand this, you understand the opportunity. If silver was worth 120 at the top and nothing fundamental changed, then 78 is not the new reality. 78 is a gift, a temporary discount created by paper manipulation. A window that will close when the March delivery crisis forces repricing. Let me be very clear about what I think happens next. I believe silver reaches $500 within the next 18 to 24 months, not because of hype, not because I want it to happen, because the math demands it. Supply deficits of 150 to 200 million ounces per year cannot continue indefinitely. Stockpiles are nearly depleted. China has restricted exports. Industrial demand is exploding. JP Morgan is positioned for massive gains, and the COMEX has promised 4 times more silver than it has. Something has to break. Either the paper market loses all credibility and physical premiums explode permanently, or the paper price rises to reflect physical reality. Either way, silver reprices dramatically higher. Now let me give you some perspective on $500 because that number sounds extreme until you do the math. In 1980, silver hit $50. Adjusted for inflation, that would be over $200 today. But that does not account for the increase in money supply. If you measure silver against M2 money supply, the amount of dollars in circulation, silver today should be trading between $300 and $600 just to match the 1980 peak. We have printed trillions of dollars since then. The purchasing power of each dollar has collapsed. But silver is still measured in those same deflated dollars. At $500, silver would simply be catching up to monetary reality. It would be reflecting the true devaluation of the dollar that has occurred over 45 years. This is not silver becoming expensive. This is the dollar revealing how cheap it has become. Now I need to address risk because no analysis is complete without it. Could silver go lower before it goes higher? Yes. Bitcoin historical patterns show 70% drawdowns in bear markets. If silver follows Bitcoin lower, we could see $50 or even lower temporarily. The deleveraging might not be complete. More margin hikes could come. More liquidations could cascade. But here is what I believe. The structural tightness is too extreme. Lease rates at 6.1% tell you physical is unavailable. Backwardation tells you buyers want metal now. Chinese vault drainage at 73 tons per day tells you demand is overwhelming. COMEX math of 429 million against 103 million tells you a crisis is coming. Even if we see more volatility, even if prices dip lower temporarily, the destination is the same. Higher, much higher. The fundamentals are screaming. The question is not if silver reprices. The question is when. And based on the March delivery timeline, based on Chinese vault drainage, based on lease rates and backwardation, I believe we are weeks away, not months. Now let me talk about what you should do with this information. I am not a financial advisor. I cannot tell you what to buy or sell, but I can tell you what the data shows. And I can share what I believe based on that data. If you are holding physical silver, do not let the paper price scare you. The paper price is manipulated. The physical market tells a different story. Shanghai at 100 while COMEX shows 78 tells you which price is real. Hold your metal. This volatility will pass. The fundamentals have not changed. If you got liquidated last week, I am sorry, that is painful. But understand what happened. You were not wrong about silver. You were wrong about position sizing. You used too much leverage. The lesson is not that silver is bad. The lesson is that leverage in manipulated markets is suicide. If you are looking to buy, this crash created an opportunity. Premiums on physical are still elevated, but lower than they were at 120. Finding physical silver with reasonable premiums right now is like finding a discount that the smart money is taking full advantage of. If you have no position and are not sure what to do, study the data. Verify everything I have said. Look up COMEX open interest yourself. Look up Shanghai prices yourself. Look up lease rates yourself. Do not trust me. Trust the data. Now let me leave you with this thought. In every generation, there is a wealth transfer, a moment when those who understand what is happening accumulate assets from those who do not. Real estate in the 2000s, tech stocks in the 2010s, crypto at various points. These moments reward the prepared and punish the reactive. Right now, in the silver market, one of the largest wealth transfers in commodity history is setting up. On one side, JP Morgan with 750 million ounces, China restricting exports and draining Western vaults, industrial demand that cannot be substituted, supply deficits that cannot be fixed for years. On the other side, retail traders who just got liquidated, paper prices that say 78 while physical trades at 100, mainstream media telling you the bull market is over. The transfer happens whether you participate or not. The only question is which side you are on. Last week, millions of people transferred their wealth to institutions. They sold at the bottom because they were scared, because they were leveraged, because they did not understand what was happening. Now you understand. Now you have the data. Now you know about the 8 margin hikes, about the $920 million fine, about JP Morgan flipping long, about the March delivery crisis, about Chinese vaults 11 days from empty, about lease rates 12 times higher than normal, about 429 million ounces promised against 103 million available. What you do with this information is your choice, but know this. 5 years from now, you will look back at this moment. You will either say, I saw what was happening and I acted, or you will say, I saw what was happening and I did nothing. Both are choices. Both have consequences. Drop a comment telling me what you think silver does next. I read every single comment. If you want me to do a deeper analysis on the March delivery crisis, let me know. If you found value in this video, share it with someone who needs to see it. Most people will never understand what happened last week. They will believe the media narrative. They will think it was just volatility. Now you know the truth. Help someone else see it too. Subscribe for more analysis like this. I will keep breaking down what the big players are doing so you are never caught off guard again. Remember what I said at the beginning. Silver crashed 47% in 7 sessions. Retail traders got liquidated by the millions. And JP Morgan was taking delivery of 99% of all physical silver on the worst day of the crash. That is not coincidence. That is strategy. And now you know how the game is played. This is the hidden economy because the real story is never on the surface. I will see you in the next one.